Hello everyone, my name is Radan Vodko, CEO and Head of Research at Quantpedia. So today's video will be a little different than the previous videos that I usually have. This video I would like to show you the portfolio analysis part of the Quantpedia. So I will not discuss trading strategies, I will not discuss trading signals or academic research as I usually do. So I will not discuss any new articles on our blog. I will guide you how to use portfolio analysis, at least some part of that, and I will make a few more videos to show you the capabilities of our portfolio analysis tool. Firstly, most of you are probably aware of our screeners. So I mean, that's the part of the Quantpedia where all of the strategies that we backtested with all of the codes and statistics, etc. You can easily go through this part when you have a subscription. But there is also another part which is called portfolio analysis. And in the portfolio analysis section, you can analyze those strategies, so strategies that we backtested. But you can do also more because you can build your own multi-asset, multi-strategy portfolios. You can analyze those portfolios. You can upload custom equity curves, run regression analysis on them, etc. So I will show you how does it work. So on the left side, you see that there are all of the reports and all of the capabilities that portfolio analysis sections give you. All together, there are plus or minus around 40 reports. They are split into 4 sections. The essential section are the reports that are probably used more often. And then there are portfolio overview sections that are doing some calculations regarding your portfolio. I mean, how the portfolio look like, what is the alpha, what is the clustering, seasonality analysis, etc. Then there are some risk management reports. And at the end, there are portfolio construction reports like Markowitz portfolio optimization or dollar cost averaging, etc.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
So on the left side here, you can select the starting and ending date of the analysis, and here you can add multiple portfolios. So I have here some dummy portfolio, but if you want to have multiple portfolios, you can go here, you can write test portfolio number 1, and you will have a new portfolio. When you have multiple portfolios, you can select one of them as a benchmark, another one will be the model portfolio. The model portfolio is the portfolio that will be analyzed, and the benchmark portfolio is the portfolio that you are trying to beat when you are a portfolio manager or even the trader. I mean, if you are a trader, you are trying probably to beat the S&P 500 to have a better performance. So it's always good to set up the benchmark because some of the reports are using benchmark very heavily. So here in the test portfolio, I will select the benchmark. So I will add the asset. When you want to add the asset, there are multiple possibilities. So firstly, you can use as an asset some of the strategies that we backtested. Not all of the strategies that we have in the Quantpedia have out of sample equity curve, but those that have out of sample equity curve, which is updated, which are plus or minus 500 or so, are available here, and you can select them as a benchmark or the model portfolio. Then afterward, there are ETFs. We do not have all of the ETFs that are available, but we have those ETFs that are most often used. So we have around 200 or 300 ETFs available for you in our database. There are some ETFs like SPI, small caps, large caps, growth, commodity, gold, NASDAQ, individual countries, US bonds, global bonds, currency ETFs, alternative ETFs, etc. Then we have some cryptocurrencies, and then we have euro-based ETFs. So if you are a European investor, you can select some of the ETFs that are based in euro. Afterward, there are FAMA and French data library factors. So you can even select one of the factors from FAMA and French as your benchmark. For our benchmark, we will probably select SPI at the moment because this is the easiest one. We will select the SPI. We will give it 100% weight. So this will be our test portfolio 1. It's probably better to change the name of the portfolio. So here I can change the name. So I will probably give it the name the test benchmark 1. So I will rename the portfolio. Okay, and I will select the role as a benchmark. Okay, let's move on. And here in the portfolio number 1, I will try to make some global portfolio that we will analyze, and our goal will be to build a portfolio that's performing better than the benchmark, which is SPI, which will not be the simple. Let's add some assets. So we can select the assets from our database, or we can upload some equity curve. How does it work like? So when you want to upload some custom equity curve, you can upload equity curve from your hard drive, or when you are using the Quant Connect as we are using, you can directly upload a backtested strategy from the Quant Connect. For this purpose, I will just select some CSV file from my hard drive. I prepared here one. I will select a random wisdom tree ETF. So what will the Quantpedia do is it will process underlying CSV, It will identify, yeah, here we have a date, here we have a performance. We will need to select the format, a value format is a change. Okay, and here we see how the underlying equity curve look like. And if we are okay, we can import the underlying equity curve. If we are not okay, we can change the file. So I mean, in this case, this is probably the equity curve of the underlying ETF that was stored in the CSV. So we can import that and it will be imported into the database. So here we have it, and I can select this one and I can place it into the portfolio. Okay, so let's do a quick change. I will remove these and these. I will give the 100% weight to the ETF. And right now, so what do we have in a portfolio? So at the moment, in a model portfolio, we have some random ETF from Wisdom Tree, and in our benchmark, we have SPI. Our data for the Wisdom Tree ETF ends in 2023, and it's not the newest one file, so I selected just one for random. So we need to change the portfolio range for the analysis. So I will find the model portfolio end date. I will find the start date automatically. Okay, so this is the start, and so we can do the analysis from May 2014 until December 2023. If you want to short the analysis window, you can change it very easily. Okay, so I have model portfolio, I have the benchmark. Once again, the benchmark model portfolio can be any combination of any ETFs, any third-party equity curves, our backtested strategy, so I mean anything. In this moment, it's just one ETF which was uploaded and one SPI as a benchmark. I will show you a few of the essential reports, and in the later videos, we will try to improve this model portfolio and I try to make it better and to beat the benchmark. Firstly, the most essential and the first is the basic overview. So what will the basic overview do? The basic overview report will calculate the performance of the underlying model portfolio. It will compare it to the performance of the benchmark, and it will show you equity curves, it will show you outperformance, underperformance, etc., etc. So I mean, here in this case, we see that the Wisdom Tree ETF is very, very strongly correlated to the benchmark. I mean, extremely. So I do not know what is that ETF that I selected, but it's probably some large cap fund which tracks SPI very closely, which I did not expect, but I mean, we will work with what we have. So here we can see what is the maximum drawdown of the model portfolio, what is the maximum drawdown of the benchmark. Model portfolio performed still a little better than the benchmark, but in 2022, model portfolio still performed a little better than the benchmark. So I mean, the underlying ETF is not a bad one. It has a little less risk than the SPI. Here we have a table. We can compare the performance of the portfolio, the loaded ETF and the benchmark on our selected window, and here we can see, so let's take a look since inception. So the performance of the ETF is over 12%, performance of SPI is nearly the same, so there is 0.1% difference. The difference in maximum drawdown, the ETF had the maximum drawdown minus 42% and SPI minus 33.7. So the ETF that we selected is a little better than SPI, not extremely, but I mean a little better. So we can see it here that the ETF has a very high correlation, 0.97 to equities, which is our benchmark. We can calculate the skewness, kurtosis, downside, upside volatility, serenity ratio, ulcer index, etc., etc. So I mean, all of the different types of the risk and the return and the risk to return characteristics. Personally, my favorites are Sharpe ratio since inception. So here we can see that our ETF that we uploaded outperforms the ordinary adjusted basis a little, and Kalmar ratio, which is comparison of the performance to maximum drawdown, and once again we can see that we outperform the benchmark a little, which is fine. It's surprising, but fine. Okay, here we have a chart with the annual performance, and here we have a table with the monthly performance of the underlying ETF or underlying model portfolio. Here is the rolling beta, rolling correlation, performance consistency. So what is the 1 year rolling average of winning days, so how many days of the portfolio are positive. I mean, this is not very useful statistic when you have just some ETFs in the portfolio, but when you have a trading strategy or when you have a hedge fund strategy, load it into the model portfolio, then it makes more sense, because I mean, when you have running a hedge fund or you are running some hedge fund like strategy, you want to have performance consistency over 50% or 55%. Here are some performance consistency statistics over individual years, and here we have a return quality chart. What is the return quality chart? It shows you what is the return compared to the risks, to the volatility, and it will show you what is the performance and risk of the model portfolio compared to some benchmarks. So to SPI, to benchmark, etc., and also the return comparison chart compared to the other assets. So in our case, we can check our model portfolio is the blue one. So here is our model portfolio. So we have a relatively high risk but a nice return, and all of the other benchmarks that we had significantly lower return. I mean, some of them had lower risk, but we have at the moment the highest performing. What we will try to do in the next video is we will try to move this blue dot to the left. So we will try to decrease the risk of the portfolio and have at least same performance. And there are some techniques, and I will show you how to do that with the portfolio analysis, how to change the allocation and how to improve the risk to return comparison chart. And here we have some return quality distribution chart. Okay, this is like basic analysis, basic overview. So we have a model portfolio with the selected ETF uploaded from the disk, and we have a benchmark, and we compare them. What other basic or essential reports we can use? So we have correlation analysis. So let's move on to correlation analysis. Correlation analysis is interesting because we will take the model portfolio and we will try to run the correlation against all of the different assets, and we will check out how it's correlated to the other assets. If you have multiple assets in a portfolio, we will also run the correlation among the assets in the portfolio. I mean, at the moment we have only one asset. I will show you then when we start to add more assets into the portfolio that we will have nice correlation table. We will look for assets that are less correlated, but at the moment there is just one. So a correlation table of the model portfolio is simple because we have only one asset. Also the average intra-correlation, we need at least two assets, so I'm not able to show you something, but here we can see the portfolio correlation to various market factors and segments, and we can compare how is our underlying model portfolio correlated to different segments of the market. So of course we are highly correlated to S&P 500, we already saw that in the chart. Our correlation to other developed countries is 0.84, to Pacific is 0.80, and to emerging markets 0.72, which is probably expected. Here we have a correlation to equity long-short strategies, so we can see that equity long-short have a relatively low correlation, so I mean they can be a good diversifier to our portfolio. And to some systematic factors, we see that we have a high correlation to systematic momentum, either in a sector or country momentum. We have a low correlation to commodities, either systematic factors or market factors, so this can be also a good diversifier. A low correlation to market to bonds, except the high yield and emerging market, which is understandable. Low correlation to systematic factors from the bonds. And for currencies, we have a higher correlation to carry, which is once again expected. Low correlation to all of the other factors. And we have some alternative factors, market, long only, short volatility or long short. Of course, we are highly correlated to short volatility, which is not surprising. We are also correlated to momentum in futures, and we have a relatively high correlation to private equity, to real estate, to hedge funds, merger arbitrage, which is not surprising because all of those alternative factors, they load a lot on the equity risk, and we have a portfolio, selected portfolio is mostly equities. So once again, what we will do is that in the future we will try to change our portfolio and add some uncorrelated assets so that our correlations will go a little lower, at least to equity markets. Another very essential report is equity crisis analysis. What it will allow you to see is how your portfolio reacted over the crisis period. We selected around 16 to 20 important crisis periods over the last 25 years, like a flash crash, Lehman Brothers meltdown, war in Ukraine, etc., etc. And you can take a look at how your portfolio reacts and performs compared to some other assets over those periods. So we can see that in the tech bubble burst, our portfolio would have nearly the same drawdown as the equity market. Now the question is, our portfolio started in 2013. So how is possible that we can see how it would perform in the tech bubble burst, which was in 2000 to 2003. So reason for that is simple. So we are not just taking the performance of the ETF or our portfolio itself. We are doing the regression analysis. We identify what are the main factors that are driving the performance of the portfolio. Then we create a synthetic portfolio that starts not at the beginning of your backtest, so in 2014, but which starts in 2000 or even sooner, we will see. And we use that proxy for dates when we do not have a data. So yeah, even that the portfolio starts in 2014, you are able to see what was the risk between 2000 and 2003, during the financial crisis, during the euro crisis, etc., etc. Even that portfolio did not exist at that time. So I mean, this is like one of the advantages of this equity crisis analysis report. And we can see here Russia-Ukraine conflict 2022. These are the data that are actually from the ETF or from the loaded data themselves. So here we can see that the benchmark performed significantly worse than our model portfolio, our Wisdom 3 ETF that we loaded, which is quite good. So we picked very good ETF, really by random. So I did not prepare this. Okay, and here we have some short-term high-risk periods. So I mean, all of those were periods that took longer to unfold, like 1 to 3 years. And in the second part of the report, there are some very short-term high volatility periods like impact of 9/11, internet bubble burst, quant meltdown in 2007, Lehman Brothers collapse, flash crash, Black Monday of 2011, crash of December 2018, 2020, stock market crash during the COVID, summer 2015, stock market sell-off, President Trump's trade policies in 2025. So this is how the portfolio we selected would perform over those crisis periods. Okay, so we are nearing to the end of the video. I mean the intended time that I have for this initial analysis. I will let this portfolio as it is, and in the next videos we will get back, so stay tuned. I mean, there are a lot of the reports, there are a lot of the things we will do. We will significantly improve the performance of the underlying portfolio. So because I mean, yeah, it is outperforming SPI a little, but we can outperform more, we can have lower risk, etc., etc. I will show you how to do that with our portfolio manager, portfolio analysis tool, how to find out which assets to add into portfolio, decrease the correlation, etc., etc. So I hope that you like this video. Please give us a like. If you are interested, go into how it works. If you are not our client, so in how it works section, there is a subpage called Quantpedia Pro Reports. And in the subpage Quantpedia Pro Reports, there is a list of all of the reports and all of the capabilities that the portfolio analysis section provides to you. Feel free to study. There are examples, we have links, case studies, etc., etc. So I will go slowly in the next 5 to 10 videos over whole portfolio analysis section. And if you want to be faster than I am, you can visit this section and you can learn about portfolio analysis section by yourself. So thank you very much, and I hope that you will join me in the next video.